Today, I'm head of business development for Arqam Capital in the DIFC, which is a leading investment bank in the Middle East. And a large part of the last 4 or 5 years I've spent looking at fintech and the technology sector in the Middle East and how Arqam can transform itself and stay up with the times. What I decided to do with today, which I thought would be useful, is essentially maybe just kind of show you how investment banking has been affected by technology and by fintech over the last sort of 15 years. A lot of people in the Middle East talk about fintechs in the sort of realm of retail banking. So think of, you know, Revoluts and Monzos, etc., that type of business model. But I don't hear a lot of discussion about how fintech is disrupting investment banking, and I see that as a huge opportunity in this region. And I'd like to talk through to you some of the changes I've seen in the last sort of decade or so, which I think could give some clues to my colleagues here today about fintech in the region and for investment banking. So that's what I'd like to start with today. So this is essentially just my background. I have 20 years of financial service in emerging markets, and these are some of the areas where I've worked. I've been on both the buy side and the sell side. So I've held a checkbook, and I've also marketed to the checkbook as well. So I think that's given me both sides of the equation some good experience on how to sell products and how to manufacture products and what to look for when investing in a product. This is just a snapshot of my career, if anyone's interested. I'd like to talk about the untouchable castles that were investment banks of the old days with their deep moats. IBs were successful in aggregating transactions, which enabled the capture of high rents for intermediating narrow sales between buyers and sellers. And value was really created by drawing on significant resources they had, essentially very, very large balance sheets. They were able to hire the best of people, the best of graduates. They had significant transactional data and information arbitrage between the market participants and from what was happening in real time. And they were able to leverage this to accurately price risk. And that enabled them to build client networks. And it was very difficult for smaller players in the market to compete with investment banks historically. They just simply didn't have the money, the same level of balance sheet. Then 2008 happened and it created a perfect storm, which led to some regulatory pressures that essentially started to tear down the kind of moats that investment banks had previously. The regulatory pressure came, really it was MiFID II, which was a big changer. It increased transparency around trading and the separation of the enforced segregation between business units. And that created a level of transparency of data within the market. And the market began to see data which they'd never seen before, which the banks used to guard very jealously. And that kind of began to sort of eat away at the information arbitrage advantage that investment banks had. Basel III, which was another regulation, it forced investment banks to increase their liquid core ratios, which meant they had to use a lot more of their balance sheet to comply with that rule. And it hindered them from using leverage. So they weren't allowed to use leverage to the same extent that they were before, and that was a big profit area for investment banks. All of these new regulations also had a knock-on effect on the cost of compliance. And I know compliance is something which is still an issue for fintechs today, the cost of compliance. Cost of compliance really about client segmentation, client onboarding, and geographic risk really escalated the cost of compliance across investment banking. Another huge change that happened on the back of all of this was the API economy, right? So the open banking laws in Europe and America really enforced mandatory APIs in the financial community. And that paved the way for fintechs to start appearing and start being able to disrupt the flow of data between investment banks and investors. And it opened the door for fintechs. Some of this I can just touch on quickly. I mean, all of this, basically what all of this meant was investment banks started earning less money. Their return on equity began to drop. And once they started earning less money, they started spending less money on technology in the short term, which meant that because they were more focused on risk mitigation. And this allowed fintechs really open the door for fintechs to come in with technology stacks that could compete against investment banks. And another thing which came off the back of this crisis was that with investment banks now earning less money on or less return on equity, they were looking for additional ways to drive profitability. So the game was basically moving towards higher volume products with at lower margins. So where could investment banks find sort of low touch customers, low margins, but be able to do it at scale? And again, this is where fintechs were able to enter the market. These are the traditional high-level areas of investment banks, which are services they provide for institutional investors. So you have capital markets advisories, which cover ECM, DCM markets. You have equity trading, credit trading. Research is a fundamental part of investment banking. And it's that IP knowledge that investment banks present to investors, which encourage investors to invest with them. And then you obviously have asset management and corporate finance. I'd like to just touch on each of these areas and just kind of give you high-level examples of how they've changed over the years. So in terms of capital markets advisory, there's a long-term squeeze on profitability. And this is pre-COVID, obviously, because since COVID, we've seen the rise of SPACs, and that's generated a lot of money. But pre-COVID, we were seeing a long-term squeeze. And there's been declining ECM revenues. Just put up some examples for you. Basically, in the IPO market in the US, the market peaked in 2000 in terms of the number of companies that became public every year. So that was 21 years ago. So it tells you the state of capital markets. Why the negative trend? Well, IPOs are very, very expensive processes. Investment banks typically earn around 7% of the total proceeds of an IPO. And throw in another 3 to 4% across tax, legal, accounting, etc. And you can see how it becomes incredibly painful to become the cost of becoming public. And this has made a lot of companies think twice. Plus, once you become public, the average cost of staying public is around $2.5 million a year as well. So you need to be a very profitable enterprise to consider go public. As a result of these costs, some of the banks have tried to initiate new technology solutions like Goldman Sachs. Goldman Sachs estimated there's 127 steps in taking a company public. And as of today, they've automated around 65% of that. And they're looking to automate the process 100% within the next couple of years. So within the next couple of years, there is a tremendous opportunity for fintechs to create automated process that pull together all the legislative and accounting and tax issues around and book building process around an IPO, because there's a big market for that. Another reason why there's been declining ECM revenues is the normalization of the mega round. Now, a mega round in VC terms is when a company raises more than $100 million. In 2012, there were 5 companies that raised more than $100 million. And as of last year, there were over 100. So you can see the incredible rise of companies that are able to raise significant amounts of capital while they're private and no need to go public. So that's been another reason that investment banks' ECM fees have been declining. The average time for a US technology company to go public used to be 4 years in 1999. Now it's 11 years. It's another example. Distributed ledger technology has significant advantages for both equity and bond issuance. Blockchain efficiencies, stores and converges all data across the supply chain in public issuance. And certainly this is going to be, I think, a massive opportunity globally, including MENA, for fintechs that are able to create distributed ledgers or blockchains that facilitate the issuance of public securities. It isn't here right now. It's very slow happening here. It needs to happen. Guys like JP Morgan and Santander are investing heavily in this space. And they're saying in public research I've seen that they can reduce the cost of public issuance by 80% over the blockchain. Corda is a very good example of a company that's building the next generation infrastructure for permissioned ledger, if anyone wants to look them up. Lastly, I'd like to talk about direct public offerings. This has also been another growing threat to investment banks, where companies previously, if you want to go public, you need to engage an investment bank, not just for underwriting, but for book building and managing the whole process. But now we saw companies like Slack and Spotify that were able to go and become public companies without using investment banks. They're called direct offerings. Previously, direct offerings meant that you could become a public company without raising new capital, just by selling secondary shares. But now that's changed recently, and you can also do a direct public offering and raise capital as well as sell secondary shares. Just to give you an example how important this is, when Slack became a public company through a direct offering, the investment banks lost around $100 million of fees. Airbnb was toying with the idea of doing a direct offering, but in the end, they did a traditional IPO. On their IPO, there were 37 investment banks, and which shared $245 million of investment banking fees. So that kind of gives you the idea of the future the future sort of threat of direct public offerings to investment banks. In terms of corporate finance, one of the things we're seeing is over the last 10 years, especially in the mid to large cap space, a lot of corporations are executing M&A deals in-house. They're no longer paying for external advisors like banks to come and advise them and help them. What we find is, what we're seeing is that corporations with specific sectors, that operate in a sector, they hire people from within their sector with significant experience and financial experience, and would rather use those in-house expertise and save potentially millions of dollars in the process by using their own employees versus investment banks. In 2015, around 20% of M&A activity in the US was without external advisors, and this is a growing trend. Recent examples would be Apple's acquisition of Beats, Comcast's acquisition of DreamWorks, and Facebook buying WhatsApp. These were all examples where they used their own internal employees on the whole process without any banks being involved. All of those transactions I just mentioned were worth more than $31 billion. So you can imagine the loss of fees for investment banks. Specialization is another issue. A lot of specifically technology companies, when they're looking for either to acquire a company or sell themselves or to raise capital, they're increasingly turning to specialized technology boutiques like Catalyst or Scenic in San Francisco, where you can speak to essentially, finance expertise, but financial experts who have significant technology understanding, a lot more than a traditional investment bank that have a kind of generic understanding across sectors. And I think this is going to increase a lot more. And I think here in the Middle East, you'll also start to see a proliferation of technology boutiques that have strong relationships with international investors and have in-house capabilities to produce fundamental research across the technology value chain. Another trend that we're seeing, excuse me, another trend is M&A as a service. Sort of companies like Axial Networks, which is, if you like, the Tinder for M&A, they are digitally connecting sellers and buyers. And so Axial did around $30 billion of transactions on their platform since 2010. So, you know, you essentially, if you're a seller of stock, you sign up to Axial's platform, you put a deck of yourself on their platform, and global international investors will see it and contact you directly to invest and pay a commission to Axial. I think that is going to grow more, especially in the small to mid-cap space. And then obviously there's digital funding like crowdfunding. Crowdfunding has been very, very popular. Everybody knows crowdfunding. It's about 50 billion has been raised on crowdfunding sites around 50 billion was raised in crowdfunding in 2017 alone in 1 year. So it's a very popular form of digital fundraising, but crowdfunding sites are generally not profitable. I've looked into a lot of them over the last 2-3 years, and very, very few are profitable. You need to have extremely large amounts of scale before you become profitable. And I think that's why you're seeing consolidation happening within the crowdfunding world now, where crowdfunding sites are starting to merge with other ones because they need that scale. And I think another area, if any of you are interested in crowdfunding, is really to look at the opportunity of secondary liquidity, because one of the problems with crowdfunding is once you invest in a company, how do you sell your shares? Unless that company gets bought or goes public, you're stuck with those shares, and it could be for 10, 11 years or more. So crowdfunding sites really are looking now to go downstream and create trading platforms where you can buy and sell private shares in private companies. And that's why you've seen the success of companies like Forge and SharePost and EquityZen in the US. In terms of asset management, I think asset management, we've started to see some progress over here in the Middle East. There's, you know, companies like Wahed Invest focusing on sort of millennial Muslim investors. You have Sarwa, and you have a couple of others like Stashaway, I think, and a couple of others that are coming over here from Malaysia. I've been surprised at how slow the Middle East has been at incorporating Robo Advisory. It's the technology behind it is not expensive, and essentially a lot of it has become commoditized, so you can go to the market very quickly. But let's talk about how sort of millennial investors have kind of transformed the look and feel of wealth management over the last sort of 10 years. So first of all, wealth managers, by using technology, they figured out that there's money to be made at the bottom of the pyramid. You know, typically, if you're a young person at university and you had, $100 to invest, no one cared about you. But because of technology, now you've become important, and because of fractional investments, you're now a valued investor, and people want you as their customer. And so, really, the low-cost, low-touch customer has now, through technology, the line between what a dedicated asset manager and what a personal finance app on a phone can do is become increasingly thin. So that's had an impact. The rise of passive investing has significantly changed the wealth management, asset management industry over the last 15 years. The separation between alpha and beta has accelerated the investor's allocation to passive products in search of low fees and broad beta exposure. Between 2007 and 2017, assets under management at BlackRock, Vanguard, State Street, Fidelity went from 7 trillion to 16 trillion. You can't ignore that. And over the same period, the total assets by America's 10 largest investment banks only decreased by 6%. So you're actually seeing a significant bifurcation there. So investment banks are losing out in the game to bank wealth management at the bottom of the pyramid. Fintechs are winning that business. But another thing affecting wealth management for investment banking has been sort of the low cost managers. So low cost platforms and asset managers from investment banks have not been able to really drive returns at lower fees, as well as specialized low cost investment managers. We're seeing a lot of the BlackRocks and the Charles Schwabs, etc., offering zero fees on on some of their funds, and you can't compete with that. I'd like to talk about Robo Advisory. I think everyone on this call knows about Robo Advisory. It's no longer an ambition; it's a reality. The top 5 robo advisors in 2020 last year managed $320 billion. That'll be over $1 trillion within the next 3 to 4 years. Here in the region, we've talked about some of them already, like Sarwa and Wahed. I think what you saw with Kipco investing into Sarwa is a clear example of whichever fintechs decide to take the brave step in setting up more of these robo advisories, etc. You will see that institutional platforms like Kipco, like the EMBDs, and like these other asset managers that do not have the kind of nimbleness and the flexibility and the understanding on how to set up a tech stack which gives the right customer user experience for millennials, they will be very quick to invest into platforms that do it. And I think that's an increasing trend. Artificial intelligence is something that will pop up in this presentation several times. It's key for wealth management. The versatility of artificial intelligence, and it gives dynamic architecture to wealth management. And with the UAE and Saudi collectively announcing that they're going to invest $230 billion by 2031 in artificial intelligence locally, I think fintechs would be crazy not to take advantage of that liquidity. There's an opportunity in MENA, I think, for segmentation in robo advisory. Right now, it's just kind of targeting millennials, but I think there's an opportunity for apps to target millennial ladies, target students, target etc. There's more segmentation that should be done. And lastly, I think I just wanted to talk about a couple more things. One is, which relates to robo advisory, it's really controlling the mobile interface. 30% of millennials have never visited a physical bank branch, and they're hyper connected and represent around 50% of all mobile banking and finance products. So if you're a fintech and you're a B2C business and you haven't invested in the highest quality interface for a mobile app, you are doing a disservice to yourself. And lastly, I'd like to finish with talking about the shifting investor profile of wealth management. Today, the total assets globally under management are around $100 trillion. The fastest growing areas of new wealth to come into assets under management over the next 5 years will be South America, Asia, Africa, and the Middle East. So we're already sitting in the Middle East, and Africa is right on our doorstep. So there's a tremendous opportunity to not just look at growing within the GCC or North Africa, but also looking at the Middle East. And the digital wealth management businesses that focus on localization of their apps and products will be the most successful ones. At the moment, what I'm seeing is a lot of developed market products just being replicated over here without really thinking about localization. Research, which is fundamental to all investment banks, it's really the IP that resides within an investment bank, and your ability to differentiate yourselves from all other investment banks on the street is your IP. It's the people you have, and it's the research you produce. What knowledge can you share with investors to give them the confidence that you're the best bank to bank with? there has been very, very little innovation in this space for the last 30, 40 years. But what happened after the back of the 2008 financial crisis was significant regulation came into the space. And MiFID II sort of unbundled the research and execution that investment banks had before. And off the back of that, we're now starting to see a lot of changes, right? So I read a report by Quinlan, which is a highly respected research company, and they said that only around 1% of all research produced by investment banks is being read. And there's a reason for that. It's legacy, it's awful, it's dreadful, it's reactive, it's not proactive. And there's significant disruption that needs to take place, not just in the content within research, but also within the delivery. As of today, there is no specialized research company that I've seen in the Middle East that focuses on providing pre-active, by-the-minute fundamental research to institutional investors on this market. There isn't anyone. Our research model over here is still the legacy model, and there's going to be significant disruption here over the next 5 years, and I think it's a huge opportunity for fintech companies. Specialized research firms have also sort of had a big effect on investment banking's research. If you're an investor and you want to learn about the technology space, for example, would you rather go to a specialized boutique that all it does is produce fundamental research on technology and is staffed by technology experts, or would you rather buy research from an investment bank where chances are you have a generic research specialist? And this is going to be an area, guys, that you need to focus on. If you look at companies like Fowry that are listed in Egypt, I think within the next couple of years, we'll see probably around 10 to 15 technology companies listed within the region. And so technology research is going to be fundamentally important for this region. A lot of investment companies globally, this is one of the reasons why a lot of technology investment companies globally are now hiring their own in-house research analysts instead of relying on investment banks. And that's been another fundamental reason why investment bank revenue has gone down. Artificial intelligence, again, is critical. 75% of asset managers use structured and unstructured data now. So, geolocation services, if I want to figure out who's going to be the next consumer champion in the Middle East, I want to know, I want to see real-time data. I want to deal with alternative data companies that are scraping the web, using social media, using geolocation services, using a multitude of alternative data to create one extremely rich data set that gives me fundamental insight into what's happening within consumerism and MENA and in real time. And that's significantly different from what's available today. A big opportunity again for fintechs. So just to give you a statistic, 75% of institutional investors use multiple data sets in real time for the interactive mapping of data, pricing, desk news, etc. There's some, if you see the way Robinhood and Wealth, Betterfront and companies like that, the way they show you small kind of fundamental bites of information, that's kind of also what institutional investors want to see as well, but just a lot more rich in data and in real time. One of the areas which has been significantly decimated in investment banking by technology has been equity trading. Equity trading used to be one of the biggest profit centers for investment banks, especially prop trading. What Goldman Sachs earns in 1 year today is what they used to earn in 10 days in 2010 from their prop trading. So what we're seeing now in summary, because of sort of the quantitative approach to technology trading now, what we're seeing is that lower volumes with lower volatility, more low touch and electronic trading versus high touch, and reduced spend on research has attributed to a decrease in trading activity and lower portfolio turnover amongst investors. The Volcker rule and the Dodd-Frank regulation increased capital requirements from regulators globally, which has massively impacted prop trading. Goldman Sachs prop trading, their profits, it used to be around 20% of their global profits used to come from prop trading. Sorry, 70%. Now it's around 20%. So you can see the impact it's had. What's really emerged over the last 10 years has been the emergence of quantitative flow monsters. These huge quantitative technology companies like Jane Street that essentially are technology companies replacing investment banks because of their highly sophisticated trading infrastructure that provides rapid execution at a fraction of the cost. Jane Street, as an example, they execute around $13 billion of equities a day across 75 exchanges around the world. Across all asset classes, they execute $15 trillion in a year. So you can see the size and scale of being able to execute all of that and be able to house it and digitally execute it without any mistake requires a significant amount of expenditure on technology. And they're going head to head with investment banks. And they've essentially commoditized equity trading now. It's like selling butter. It's probably, what investment banks were earning 10 years ago, it's probably gone down by around 90%, 95%. Also, just to touch on some other areas, transaction cost analysis is fundamentally important now for an institutional investor. Institutional investors want to reduce the amount of brokers they use globally. So if you're a fund manager sitting in Paris, you don't want to have 5 brokers for the Middle East. You only want 2 maximum. It's less of a headache, and you want to make them compete against each other. And really what you want is to see the transaction cost analysis, right? So if whoever I give my flows to in the Middle East, what price do they transact at? Do they give me the price I wanted? Do they give it to me immediately? How slow are they? What's their cost, etc.? And then they compare this against your competitors. So being able to have the in-house software to be able to show institutional buyers that this is your transaction cost analysis, this is why you should use me, that's missing from this region. Nobody is using it over here. It's another opportunity for fintechs. So going to talk about credit trading now. Credit trading is, or trading in bonds, is really one of the last areas of investment banking that hasn't really been disrupted yet. It's a huge opportunity. Fintechs haven't really gone after this space yet. And I think it needs to happen. It hasn't even happened in developed markets yet, but this is going to be an area where we will see massive disruption coming. It needs to be disrupted. There hasn't been any real disruption in this space yet. This used to be a cash cow over the last decade. Over the last decade, that's changed. Volumes in bond tradings have decreased. There's been low volatility and low interest rates, and high cost of capital have all combined to kind of eat into the profits of investment banks that were trading here. What are the kind of disruptions we have seen taking place so far? Digital decision making. It's all about artificial intelligence. Alliance and Bernstein, which is an asset manager in America, they manage $500 billion out of New York. They're a good example of a company that's using artificial intelligence. They have an in-house robot software, if you like, to handle thousands of bond trades worth nearly 19 billion in the first 3 months of rolling out this software. Today, Alliance and Bernstein, around 35% of all of their bond trades are done by robotic software. So this is software that goes into the market, finds the best price for execution at the volume you're looking at, and does it all automatically without speaking to anyone. And this is going to increase significantly, right? So Goldman Sachs has an algo which prices and executes bonds up to $2 million, but they're going to move that to $100 million within the next couple of years. So you will see this just more and more happening. Another area of disruption has been the electronification of debt markets. Bond markets essentially, and still is today in emerging markets, a telephone business. Your client calls you, or Bloomberg chat, right? They'll call you and you have to find you price a bond for them, you build in your spread, and that it's a very traditionalized business. But what we're seeing is electronification is now coming, right? And it's already started. Greenwich Associates, a research company, has estimated that around 1/5 of all US investment grade bonds are now traded electronically. And that is more than 300% than 10 years ago, right? So the growth is starting from a very small base, but it's growing exceptionally fast. And now you're seeing companies like market access, independent digital platforms that are creating dark pools of trading between buyers and sellers of bonds and creating a price. And these are becoming more and more popular. And what we're seeing is companies like MarketX are now averaging around, 150 to $200 billion of volume a month, right? And that's going to reach into the trillions over the next decade. Today, here in the Middle East, there's still an opportunity, I think, for independent fintechs to create platforms for dark pool discovery of pricing in corporate and junk bonds. It's still a telephone business. We touched on artificial intelligence already. No need to go there. I just wanted to give you another example. ING Bank have created a product called Katana, which is an artificial intelligence visualization tool, and it priced bonds 90% faster than humans do, and reduces trading costs by 25%. And this is a product that will now be spun out of ING and will be sold around the world. Lastly, bond ETFs have really reshaped the bond market globally. I'd say around in the last year, probably around $150 billion have flowed into bond ETFs. And this has been enabled by really an accelerating shift towards algorithmic trading in more liquid corners of the market. Today, Citibank can select a basket of bonds and do this all digitally, select a basket of bonds, price them, and house them and list an ETF 100% automatically. So you will probably see a proliferation of ETF bond products over the next 10 years. There is very, very little ETFs here in the region. I know there are some trading aspects and regulatory aspects that have sort of hindered that growth, but it needs to happen. ETFs will also be complementary to Robo Advisory and passive investing, and so another opportunity for fintechs in the region. So where are investment banks today? I think investment banks are no longer the sort of unpenetrable castles they were. They've realized that. So they've taken a new attitude. I think it's collaborate or die slowly. They've realized that. So, with the development of APIs and cloud technology, it's allowed sort of peaceful coexistence between the investment banks and the fintech community. IBs no longer see themselves as prison wardeners, right, where they would capture investors and never let them go. They now see themselves as digital hotels where, fintechs can come and stay, investors can come and stay as long as they want to leave. It's about, whoever perfects the user experience will have that stickiness, and that's what they're kind of competing on. Investment banks are also now beginning to understand that their moats have evolved and are evolving on a daily basis. And really, I think the smart investment banks like Goldman Sachs are now kind of focusing on where do they compete against fintechs and when do they work with fintechs. And a lot of investment banks now see themselves as infrastructure as a service for fintechs. If you're a fintech and you want to trade regional equities, you don't have enough money to go buy a seat on every stock exchange. And even a small investment bank like Arqam Capital, I estimate we've probably spent around $40 million in the last decade on technology to enable us to execute in very, very low latency for global institutional investors. Fintechs, it's very difficult for fintechs to have that access to capital. And so some of the original moats that investment banks had are still relevant for today, but they need to share those with the fintech community to have that kind of symbiotic relationship. Sorry, I think I just lost my screen. Yeah, sorry, anyway, I lost my screen, but I think I'll leave it at there. I hope that wasn't too long.
Wali, I think you navigated towards the end. I'm not sure if you had a few slides, we can go over them, unless you were done anyway.
I think I just wanted to quickly just pull out, I can't remember what I actually had on the last slide. Yeah, look, I mean, I think what you'll see here in the Middle East is exactly what we've seen in developed markets is that investment banks here are going to now focus more and more on the low touch, low margin consumers, right? At the bottom of the pyramid is something which they weren't doing before, and they're going to start competing against localized fintechs. But also, in areas where they're not able to kind of replicate the same user experience that fintechs are creating, I think you'll see a step up in acquisitions. Really, the last point I want to leave everyone with is that the MENA region accounts for 9 to 10% of the global population, plus with very, very strong young generational dynamics. But the MENA region only invests around 0.5% of the global fintech spend annually. So there's a tremendous underspend in the fintech space. I think the regional governments are aware of this, and we're seeing a lot of Dubai, Abu Dhabi, Riyadh, and Bahrain, etc., and all these guys all of the governments beginning to invest more and more capital into the space. They're also looking at open banking, and so really, I think fintech is the fintech space. Not only will more capital pour into the space, but the opportunity is going to be tremendous over the next decade. That's it.
Thanks so much, Wali. I think we can open the floor to questions. Audience, feel free to type the questions in the Q&A box, or if you prefer to speak your question, you can raise your hand and I'll give you the access to do that.
Time for tea.
I think you were very, very clear. I don't see anyone asking anything, so I think that, oh, I have someone here that's raised their hand.
Yeah, Andreas here. Hi, thanks for the excellent speech. What I would like to know is who are the investment banks in the region that are most open for collaboration with fintechs, if you have ideas.
Good question. I mean, what we're seeing is, for example, RAK Bank is surprisingly collaborative. They're working very closely with YAP, which is a neobank. So they're providing the sort of backbone infrastructure for neobanking in the region. We're seeing FAB in Abu Dhabi also is kind of leading the way for wealth management technology and sort of Robo Advisory, etc. I would say probably those two banks are quite interesting to look at. But I think what you're also seeing is ENBD and Mashreq Bank are also focusing on different areas, more on the sort of payment structure side, which is very interesting. I think all the banks in the region are open for certain discussions, and specifically around payments. I think capital markets is still kind of a slow area.
Thanks a lot.
Welcome.
And just to add to that, we've also seen a lot of these banks work directly with our fintech startups that are part of our accelerator program. So many of the big banks in the UAE actually are open to working with fintechs. Does that answer your question?
Absolutely.
All right. Does anyone else have any other questions? Okay, I can see some questions have come in. What are the main challenges for tech startups in the Middle East?
I think it's been regulation, right? I think because a lot of, I'm on the advisory boards of a few tech companies, and, one of their sort of first questions is like, if I set up in the DIFC, am I allowed to sell outside of the DIFC? Do I have to also have an onshore license, ESCA approval? And it's still, I think, the legal sort of regulation space is still a little bit cloudy for fintechs to kind of understand what they can and cannot do. And I think that's one of the reasons why the FinTech Hive is really important, because you can find that that kind of advice quite quickly with there. So I think regulations need to improve. I'd love to see open banking regulations happen within the next 12 to 18 months. That would really escalate the ability for fintechs to intermediate sort of services and data provision. Capital now is available for pre-seed and seed, etc. Accelerating the early stage funding is available now. I think one of the things missing in the region, and one of the things Arcam is now providing, is late stage capital for fintechs. For once you get to Series A, where do you go after that for your capital? I don't like seeing the Middle East youngest and brightest and most special fintechs going international looking for capital from America and Europe. They should be getting it from here. So I think lack of capital for late stage funding is also an issue here. And then I think, maybe there's a lot of young, bright Arabs in the Middle East that I've met, so I'm not worried about talent. But I think maybe access to regional technology is also there. You have fantastic Indian, Pakistani, Bengali software programmers that are available and know the Middle East very well. So for me, it's really regulation and late stage capital.
Mohammed also asks another question. Is copying the models in the West the way forward in the Middle East? Is that the fastest way to make a business? What are your thoughts on moving forward?
It can be. I mean, if it gives you first mover advantage, then it's a good thing to do, right? But I think one of the mistakes a lot of fintechs make is really getting to understand how much money they can make from their product to the proposed market. The Middle East is, it's the Middle East and North Africa. It's a sizable market, but you have to understand what does your client look like? What's their disposable income? And is it a strong fit for what you're presenting in terms of a product? So just to give you a generalized answer, I would say, yeah, copying a strategy in developed markets is fine, as providing you're the first mover here, and providing that you localize that product to, in terms of fixing sort of problems that are inherent with this market that are not in the market from where you got the product.